As option traders, we love to sell options because it puts the probabilities in our favor, except for now. Welcome to the 12-Minute Trading Market Minute for Sunday, the 27th of November. There are three things that I want to show you here, which leads me to the conclusion that selling options might be a little bit dangerous in the short term. First of all is the average swing length. The average swing length off of the bottom of these moves, we've seen 604 points, we've seen 496, and now recently off of the bottom here, we've seen up to about 549. So it's right in the middle of the average swing length, and we might have just a little bit more to go before things start to get a lot more volatile. What we've seen this year is that market tops tend to be really volatile. First of all, to the upside, they tend to reach into the sky on the final move, which wipes out one side of the ledger, and then from there they sell off very strongly, leading to a wipeout of the other side of the ledger. So we might see this nice little rally here start to transition into something which becomes a lot more volatile. And typically that spells pain for option sellers. The second thing I want to bring to your attention is the difference between historical and implied volatility. Implied volatility is the blue line, and this is the implied forward move as measured by the options market. The orange line slightly above it is the realized volatility over the past X number of days. And what it's showing is that the realized volatility is actually much stronger than what's being priced in. So the risk premium priced into the options is not really paying us very well to be taking the risk that we do when we sell an option. It's much better for us to have overstated implied volatility, which is much above the historical or realized volatility. The other situation is where we have this, and it doesn't happen all that often, but again, realized volatility being higher than implied means that we can be in trouble in a hurry because our positions are not getting much distance on them when we sell them. The number three thing that I want to bring to your attention is the VIX. The VIX right now has just basically collapsed. Especially over the last couple of weeks, it's well below the lower Bollinger Band, which means that it has come too far, too fast, and we should start to see this increase. And that typically is one of two things. Either we're going to see bullish divergence on the VIX, which means as the price goes higher, the VIX goes higher. That's a very dangerous thing. That implies that somebody knows something. The other thing that we could see is the VIX actually just going higher because of the fact that it is going higher and the price is going lower, which would be more normal, which means that we are seeing the price distribute to the downside. Either way, it implies volatility is just around the corner in terms of the price. So to me, those are three warning signals that we have to be able to heed and to keep our offense kind of quiet this week until these blow over and the volatility normalizes once again. Volatility, after all, is mean reverting, and it will revert back to the mean. It always does. That's it for today's Market Minute. Thanks for listening. We'll see you in the next one.